$115,000 of your $500,000 tech ETF is concentrated in 3 stocks. You own it passively. You believe you're diversified. The prospectus says you are. But in June 2025, when index providers announce rebalancing, your fund will execute forced sells you never approved, and the tax bill could hit $15,000 to $25,000. This is the hidden concentration risk nobody mentions until it's too late. Most high-income portfolios hold tech ETFs like QQQ or Vanguard Information Technology, VGT. These sound diversified. They hold 100-plus stocks, but the top 3 holdings, Apple, Microsoft, Nvidia as of Q4 2024, represent 23% of fund assets. On a $500K position, that's $115,000 concentrated in 3 companies whose voting power coordinates through the same index holdings, in the same fund structure, without disclosure of rebalancing triggers or forced trade timing. Here's the gap most investors miss. Passive doesn't mean safe. It means your trades are controlled by index methodology, not by you. And index methodology changes happen on published schedules buried in the prospectus. Form N1A for QQQ, Form N1A for VGT, that most investors never read because they are 400-plus pages of SEC legal language. Let's break it down. A $500K position in QQQ holds approximately $115K in Apple, Microsoft, and Nvidia combined. 23% weighting, as of 2024 Q4 data from Invesco's Form N1A filing. When S&P or Nasdaq announces a methodology review, which they've signaled for 2024-2025, they announce rebalancing windows. These are not optional for the fund. Your shares will be rebalanced. You will not vote on this. Your broker will not ask permission. It happens because the index says so. Now, where does the tax hit come from? Embedded capital gains. If you bought QQQ or VGT in 2022 or early 2023, your cost basis is lower than today's price. Apple, Microsoft, and Nvidia have appreciated significantly since then. Let's say your embedded gain on the forced $75K liquidation, 15% of the concentrated position, is $30,000. When the fund sells, you trigger long-term capital gains tax at 15% federal plus 8% net investment income tax, NIIT. If you're a high earner, that's 8%. Add state income tax, California, New York, or Massachusetts could add 13%, and your total tax rate is 29.32%. On a $30,000 gain, that's $8,700 to $9,600 in federal and state tax liability. You didn't control the trade, you didn't time it, the index did. But here's what the prospectus doesn't emphasize: voting power concentration. When your fund holds 23% of its assets in 3 stocks, those 3 stocks get concentrated voting blocks from the fund's proxy voting power. The fund votes all shares it holds. If the fund and other passive index funds combined own 15-20% of Apple's shares, which they do, they control a significant block of shareholder votes on corporate governance, executive compensation, and board elections. Index funds coordinate indirectly through shared index methodologies. They don't coordinate explicitly. That would trigger SEC Schedule 13D disclosure rules, but they move together. If Nasdaq changes Apple's weighting, QQQ moves. If S&P downgrades a sector, every S&P 500 fund rebalances. This is systemic coordination without explicit coordination, and it's nowhere in the marketing materials. Why does June 2025 matter? Major index providers have signaled methodology reviews for 2024-2025. The Nasdaq 100, which underlies QQQ, and the S&P 500 have both flagged potential rebalancing to address concentration risk in megacap stocks. When they announce these reviews, rebalancing windows open. Once they open, forced trades execute. You have no veto. So what should a high-income household actually do? First, audit your holdings. Pull the latest Form N1A prospectus for any tech ETF you own. Look for Section I, the fund summary, and find the holdings table. Calculate what percentage your top 3 holdings represent. If it's over 20%, you're concentrated. Second, check the investment objective and investment strategies sections for language about rebalancing frequency and methodology ties. Third, understand your cost basis. If you have a $30K plus unrealized gain in a concentrated position, you're vulnerable to tax drag from forced rebalancing. Finally, consider whether holding concentrated passive positions before a known methodology review window makes sense for your tax situation. This isn't advice, it's analysis of current structure. Passive funds are not passive investors. They're mechanically driven by indices, and indices change. When they do, your portfolio changes with them, whether you want it to or not. The tax bill follows. Same facts, different reading. Follow the trail.